Hi everyone, welcome back to my YouTube channel, and this is Manisha, and in today's video we are going to solve few quiz question, and this one is from the chapter 6 of financial accounting. So as you know, ACCA has launched its own material, that's a study hub. So Copland and BPP are no longer like approved content. Still, you can use the BPP and the Copland as to practice the extra question or more one, no issue at all. But yes, please make sure to use the study hub as well. Okay. So now in this video we will solve chapter 6 quiz. Previously we have covered till 5. So if you have missed my previous video, don't worry. There is separate playlist being created on my channel. Go and check it out. You can access those video at free of cost. So let's start the today video, and that's chapter 6. The first question is, Kimi has discovered the receivable of 4,000 are Kimi has discovered that receivable of 4,000 are irrecoverable at the reporting period end. Her receivable balance before accounting for this 4,000 is 100,000. And allowance equivalent to 4% is required on the remaining receivable. There was no allowance for irrecoverable debt at the start of the period. Means our opening balance for the allowance is 0. So what is the expense in the P&L in respect of IRD, irrecoverable debt, and allowance for receivable? So let's reread the question line by line, then we will figure out what item will we go into the P&L. So first is that 4,000 of irrecoverable. So as this is now no longer we are going to recover from customer, this is obviously going to be in the P&L as expense. So 4,000 is pretty much sure. So by identifying this, it's also confirmed that our option A and B is now out. Answer could be either C or D, but 4,000 is pretty much sure. Now her receivable balance before accounting for 4,000. Okay, before accounting for 4,000 was 100,000. So that means 4,000 has been included in this 100,000. And next we have an allowance equivalent to 4% is required on the remaining receivable. So the remaining receivable balance is our 100,000 minus 4,000. Then we have 96,000, and the 4% of this is 3840. So this is the closing balance for the allowance. So in case of allowance for receivable, only movement will go to the P&L. See, previously opening balance was 0. It has been now increased to 3840. The movement is of 3840. So this movement is increasing movement will be debited to the P&L. So that means 3840 plus 4,000. This will give us total of 7840. Next we have a receivable from customer was expensed in the irrecoverable in the last accounting period. During this accounting period, the customer settled the amount in the full. What is the journal entry to record this receipt? See, customer is paying money to me. So debit portion will be, we are pretty much sure debit portion will be either cash or the bank. So if you look at the option, only two option is having the bank. So C and D is out. Yeah. Now on the credit portion. So if we are booking the irrecoverable debt once, it is at the point of time it will be reduced from the receivable. So there is no any relation with receivable ledger if we are going to recover those amount. So obviously receivable will not be the cashier. So credit will be irrecoverable debt. B. Okay. Next, Imrul uses manual books keeping system. He had tried to prepare his receivable ledger account below. He needs his work check to identify whether he had made any error. He has little accounting experience and has drafted the trade receivable ledger below. All right. So as he is having little accounting experience, so he have prepared this ledger. We need to identify the mistake, correct it, then need to find what is the correct receivable ledger account balance. Let's solve this question in the ledger. So this is the debit portion of the receivable and credit portion. So balance brought forward 10,400 is correct. Why? Because receivable is the current asset and it should be always on the debit side. Okay. Then sales return. Sales return is the goods that customer returns to you. That means those amounts you are no longer going to receive from the customer. That means we need to reduce our receivable ledger by how much? 500. And reducing in receivable ledger means it should be credited. It should be credited. All right. Next we have irrecoverable debt. So irrecoverable debt again means we are no longer going to receive that amount. It's a bad debt. So again we need to reduce the receivable balance, and decrease in receivable means it should be on the credit side. Contra with payable. Yes, contra with payable will reduce both receivable as well as payable ledger account, and decrease in the receivable means it should be on the credit side. So 3000 will be again on the credit side. Then we have balance carry forward. See, these are the common mistake that a student do. If you want balance brought forward on the debit side, now carry forward balance should be on the credit side, so that next year it will be opening. Okay, so it's wrong here. Now sales. If we are selling the goods on the credit to the customer, so obviously it will increase our receivable. Increase in receivable means debit. So here this Imrul has done the mistake. It will be on the debit side and amount will be 84,300. Now next we have a bank from the customer. That means customer has paid their amount, and it will reduce the receivable, and reduce in receivable means credit side 71,300. Next, we have allowance for irrecoverable debt. Allowance for irrecoverable debt will not appear in your ledger account of receivable. So it's simply allowance. So it won't create an impact on the receivable ledger. So now what the difference we are having? Our debit side is more than the credit. That means 19,000 is the carry forward or opening balance for the next year. So 19,000. So option B. Okay. Question number 4. On January 20X6, a small company had an allowance for irrecoverable debt of 1,000. So this means opening balance of allowance. During the 20X8, debt for 500 were written off. So this means in this current year, 600 were written as a irrecoverable debt in the P&L. 80 was paid by liquidator of the company whose debt was written off completely in 20X5. So this amount is paid back. So it will reduce irrecoverable debt amount. So because it has been written off previously in the 20X5. At the end of the 20X6, it was decided to adjust the allowance for irrecoverable debt to 900. This means the closing balance. So if you compare opening and closing, allowance has been decreased by how much? 100. So what is the total expense for irrecoverable debt that should be included in the profit or loss for 20X6? Alright, so first, opening balance of allowance has given, closing balance is now 900. So means how much is movement? 100. It's increase or decrease? It's decrease. So that means it will be credited to the P&L 100. Alright. The next, this 600, it has been written off in the current accounting period. So that means this 600 will be shown as debit in the P&L. So 600 minus 100, it is 500 now. And this 80 has been paid up by the liquidator, so it is recoverable. So it will be again credited to the P&L. So 500 minus 80, it will give us 420. Next we have, which two of the following item below are source of timing difference in the supplier statement reconciliation? Alright, so the question is asking for the two options to be choose that are related to the source of timing difference in the supplier reconciliation statement. Okay, so let's first understand what's the timing difference. So basically it arises, this difference occurs when transaction has been recorded in one party book but not recorded in the other party books. And this could be due to the timing of communication, posting or processing delays. Okay, now let's go through the option and figure out which one is correct. The first one is saying cash payment in the ledger account are not yet shown in the supplier statement. Yes, this one is the timing difference because customer has recorded the payment but the supplier has not processed yet. So it's the timing difference. So option A is right. Next we have the supplier has recorded the wrong amount for purchase of payment. So again, this is not a timing difference but it's an error. The third, the credit note are not yet shown on the supplier statement for the goods which have been returned by the customer to the supplier. So yes, the customer has returned the goods and recorded a credit note, but the supplier has not issued or shown it. So again, this is the timing difference. So C. And the D, the customer or supplier has omitted transaction from its accounting record. So basically it's again timing difference. Sorry, it's not a timing difference because it's an omission and the error. So that's why D is incorrect. So yes, we are done with this part as well. So see you in the next video for chapter number 7. So stay tuned with my channel for more video like this.